So for tonight, I would love as much audience participation as possible. It'll just make this a lot more fun and a lot more meaningful for you all. So you can do that if you're brave and speak up, or you can throw it in the chat. And you can raise your hand and I'll call on you, whatever you feel most comfortable doing. But let's dive in. So today we're going to cover part 1 of deal sourcing. Is this the right? Sorry, no, we covered deal sourcing last week. I have the wrong deck up. Let me fix that. We are going to be covering due diligence. So due diligence part 1. Just to go through the agenda real quick. So welcome everyone. We're going to talk a little bit about business model and strategy. We're going to talk about markets. We're going to talk about competition. And then we'll just remind you all on deadlines and deliverables. Next week, we'll cover things like financials, forecasts, returns, all that fun stuff. So let's get into it. So I don't know if any of you have heard of this firm or this guy, Mike Maples, but Floodgate, really great early stage, seed stage based fund. A lot of great investments. Probably their most famous investment or most well-known was they wrote like the very first check into Lyft. But I just really love this quote. And where he says, we were looking for a pain point so big you needed a tourniquet. If you didn't get it, you were going to die. And to me, like, I am a big pain point focused investor. I think to the extent you get it wrong as a VC, oftentimes it's because you didn't understand the pain point. So when you're sorry, I was just looking at the chat and I was trying to figure out when those messages were sent, making sure everyone can hear me. So when you're evaluating a deal, I think, having now worked with students for the last like 14 years, invariably, I think the one area where students have to learn when it comes to doing due diligence is really understanding pain points to the point where like you kind of get a visceral reaction or feel as like you come to understand what that pain point is. Like you're starting to feel the pain that the customer is starting to feel. And as a VC, like, a lot of people talk about this concept of, is it a vitamin or a painkiller, right? And it's like, if it's a vitamin, it's like, great, like, they're good for you. You need them. You need vitamins in your diet or, you'll be sick, whatever. But you contrast that with a painkiller. Right. And if you are in pain, you will pay like just about anything, right? To get that pain to go away. I'll give you a real life example that just happened to me last month. As you might notice, I have a little bit of a black eye. And that's because I had a surgery kind of on the side of my head and it kind of bled into my eye. And the night of the surgery, I was in so much pain. I couldn't sleep. Like it was like just insane pain. And I called my doctor and I was like, I don't care what it is. I need something strong or I will not sleep tonight. And so, he prescribed me some pretty strong stuff and it knocked me out. It was great. But at that point, like I would have paid anything, right? Done anything to get that pain to subside. And as a VC, that's kind of what you're looking for. You're looking for customers that are experiencing a pain point that is so strong that they will pay like anything to have it solved, right? And if you can find companies that are doing that, that have figured out some sort of pain point and they are solving it for their customers, you probably have a really interesting business opportunity. Now, that does not necessarily mean, sometimes you think pain point, like if we don't get it, we're going to die, right? Like Mike Maple says. And so then you ask yourself, well, what about things like Spotify? Like nobody's going to die if they don't have Spotify. I mean, some people probably would actually argue with me on that point. But look at like some of their customer behavior. You had people, and I know this is quite a bit in the past, but like I lived through it. There were people that were literally doing illegal things on a regular basis. They were illegally downloading music, right? Because they wanted like a good music experience. It was that important to them. Like that pain point was really, really high. And when Spotify launched, what was interesting about it is that people, the flip side of doing something illegal was that they were doing something that was free, right? They were getting free music. But they were willing to pay Spotify money for that same music that they already had, simply because it had a better user experience, right? So then again, it was like this pain point of like trying to organize your music and listen to it. And like, it's a big part of like your life, especially as like young adults and teenagers. Like they were willing to start shelling out money for something they could otherwise get for free. Like another like strong indicator of like a big pain point that needed to be solved and that Spotify was solving. And so I know I've kind of talked about this point a lot, but when you're evaluating companies, I just can't stress enough the importance of like sitting to like talk to customers, right? Talk to people that are in the industry. Maybe they're not a customer, but they could be a customer, and spend time really understanding like, is this a big pain point? Because like we've looked at companies where sometimes the business is like really cool tech, and the entrepreneurs are like, oh yeah, like, we're solving all these problems for these businesses, blah, blah, blah. But then you talk to the actual customers and they're like, this is like a nice to have, it's not a must have, right? When you hear something like that, you're like, vitamin, I'm out, right? On the other hand, if they're like, I don't know how I would do this without this company, or like our company wouldn't exist without them, or right, like my alternative is I have to hire like 20 people to do the same function. Those types of things, that's when you should start getting excited. Like, hey, maybe there's something actually here. So, all right, we'll move on from that. But key takeaway is make sure you understand the pain point of the company that they are solving for the customer. All right, let's talk about kind of the next thing when it comes to business strategy. Anybody recognize this guy? The big hint in the background. So this is
the founder and owner of McDonald's.
Yeah, that's right. So was he the founder of McDonald's?
No, he was not. He's Ray Kroc. He franchised him.
That's right. He took him into a franchise. So he was like the founder of the franchise, but not the restaurant, right? If you haven't seen the movie, it's a really good one called The Founder, and it's like his story. And it's great. In the movie, I used to be able to like show this clip, but it got taken down, so obtained copyrights. But there's a part in the movie that also replicates this other story, where he was asking people in his circle. He was like, what business am I in? And they were like, well, Ray, come on, like you're in the burger business, obvious, right? Like restaurants, burgers. He's like, no, I'm not in the burger business. I'm in the real estate business. And why would he say that he was in the real estate business? Anybody?
Go
for it, Charlie.
I was going to say, so he would like buy the property and then sell it to people who wanted to franchise so that he was making more money because he didn't actually make that much off of franchising directly.
Yeah, so you've seen the movie.
Yes.
Okay, so that is definitely part of that, and we're going to talk about that business model. What else would be a good reason? If you haven't seen the movie, why would you think that he would respond that way? How many of you think McDonald's makes the all-time best hamburger that's ever been made? Or even like in the top like 100?
I hope no one.
Right? So they're not really in the like hamburger business. Like they're not focused on making the best hamburger. What are they focused on? What do they actually provide?
Cheap and fast food.
Yeah, well, is it even all that cheap? Can you find a better tasting, cheaper burger?
It's kind of cheap. It's like in this cheaper area.
Yeah, it's kind of cheap. It's affordable, right?
Yep.
They've raised their prices a lot in recent years, so it's not even that cheap anymore compared to other restaurants.
Yeah. But what is it? It's fast and it's two more words, two more descriptors I'm looking for.
It's convenient.
Consistent.
Yes, it's convenient. And anybody know the last one?
It's consistent.
There it is. It's fast, it's consistent, and it's convenient. And of all of those, probably the most important is that it's convenient, because fast and consistent, really at the end of the day, the real value of being consistent and being fast is the convenience you provide, right? So what McDonald's sells is convenient nutrition. And I use nutrition very lightly, very loosely. But it's convenient food. You're hungry, right? There is a good chance there's a McDonald's, right, within, driving, walking distance from where you are. And you know exactly what you're going to get. It may not be the best burger, but you know that that burger is going to taste the same, whether you're in like rural Iowa or you're in like Tokyo, Japan. It doesn't matter. Like the burger is basically going to taste the same. It's consistent. And so it's convenient because you know what you're going to get, right? There's no risk in terms of like, I don't know, is this going to be a good burger place or a bad one? It takes all that risk out of it. Now, what does that also mean? It also means convenience. You have to be located in places that are convenient to people. And so one of the things that's really interesting about Ray Kroc is he designed this business model where he solved two big problems that he had. One is he has to provide really, really convenient locations, right? He's got to provide convenience. So as part of that, he's got to have locations that are very convenient, high traffic areas, that are very convenient for people to find, get to, get in, get out. And McDonald's spends an inordinate amount of money figuring this out. In fact, McDonald's is so good at figuring out the very best place for their McDonald's locations that Burger King doesn't even bother to figure it out on their own. They would just like, oh, there's a McDonald's there? Great, we'll put up a Burger King like, a block away, right? It must be a good spot. Which is why you usually see a McDonald's and a Burger King like not too far apart from each other. I don't know if you've ever noticed that, but it's kind of a phenomenon. So that's part of it. But then the other part of it is you've got these franchisees, right? And the franchisees are out there and they've got a couple of problems. One, they're only going to buy in to your business if they feel like it's de-risked, right? Otherwise, they're just going to start their own burger place. But once they buy in, then you got to control them and you got to make sure that they maintain the consistency and the speed that you need in order for the company to be successful, for the franchise to be successful. Because if they go off the reservation and they start doing other things, even if they're very successful in that one location, ends up impacting negatively the rest of your locations. And it makes it harder to do advertising and like, et cetera, et cetera, et cetera. It's also hard to start saying like, hey, we're going to take a cut of each burger or whatever. If, you don't have the ability to like really zero in on how many burgers they're selling. And so what Ray Kroc did is he said, okay, we're going to go buy the best possible locations. We're going to figure that out because it's going to reduce the risk of our franchisees. And then we're going to own that land and we're going to lease it to the franchisee at an extremely high lease rate, right? It's going to be way higher than it would be if they leased the land on their own. But we're going to do that because it's going to be a way for us to capture the value that we are helping them create in their franchise and bring it back into our business. And it's going to give us control because if they don't obey our rules, we boot them out of the land because we own the land and we boot them out of the business, right? Thereby giving them the control they need, giving them the ability to extract really high profits, right? A really high portion of the revenue or the profits that are generated by that business, and gives them the ability to provide value back to those franchisees by saying, hey, look, we did all the research. This is where you want to be. You're here. You will have success in your business. Now, I bring that up because there are all these pieces that on the surface, when you look at McDonald's, you don't think about, right? You're like, oh, it's like a burger place. It's fast food, right? And it's like, it's convenient, consistent, whatever. But it's important to understand the business that they're in. And that business is, at the end of the day, the customer is not me and you when we go in and buy a burger. The customer at McDonald's is the franchisee, right? And so what's important then is their ability to one, create value for that franchisee, and two, to be able to extract value out of that franchisee for, extract kind of a portion of the value that they're helping create. Because you have got a lot of businesses out there that create a tremendous amount of value. You think about like airlines, and Warren Buffett's like famous for pointing this out, is like airlines are a huge industry. They generate insane levels of value, right? Like the whole idea that I can go from Utah to Paris, right, in a matter of hours, for like as little as like $500 is crazy, like crazy amount of value, right? To be able to travel what would take other, prior generations years to travel, like I can do it in less than a day. That is insane value, but like airlines do a horrible job at capturing that value because it's kind of a commoditized service, right? Like to pay $500 to travel like that is crazy relative to the amount of value that's being created. Like there are people that would gladly pay, and this sometimes happens, right? Like last minute airplane travel, like they will drop 10 grand to get where they need to go. Because at the end of the day, like that there is insane value that airlines create. So my point with that is it's not enough to be solving a pain point. You got to understand the business model and the ability of the business to extract some of the value, like as much of the value that they're helping create as humanly possible. And how they do that refers back to these various business models. So for McDonald's, it might be, hey, we have these really high leases, and then we also, you have to buy your food from us, and we charge like inflated rates on our food, and et cetera, et cetera. But then the value you get is, we help you pick the right place. We give you the systems. We basically make this a turnkey business where you're never going to get rich owning one McDonald's, but you're probably not going to lose money either. So, okay, let's move on. So when you're assessing a business model and strategy, the first thing I like to talk about is surprise. What is the pain point? Really understanding what is the pain point. Who feels not the pain point, but the pain point. That person that feels the pain point is your customer or is a customer that you need to be worried about. And then how is the company solving that pain point? So I've got two examples here. I guess they're now Meta and Lyft. So question, what is the pain point that Meta/Facebook solves? Let's go through these together.
Well, it attempts to
socialize.
solve a social aspect in terms of a pain point.
Okay, what do you mean by that?
So what I mean specifically is the connectivity that we all need as people. It's a human need to have a social structure. And by creating a business model surrounded around that, it is taking care of a pain point.
Okay. So the need for like social connection. Do you pay for Meta? Do you pay for Facebook, Instagram?
So you pay for it indirectly.
No,
Pay for it out of
I
pocket.
think the pain point that Facebook or
Go ahead.
Sorry, let's let Timothy finish, and then we'll turn it over to you, Miranda.
sorry.
Yeah, no worries. So yeah, you don't specifically pay for it. However, your attention and your clicks feed into its business model through its advertisements and other things.
All right, you want to expand on where he was going, Miranda?
Yeah, I think like in addition to like solving a social problem, it's like kind of making it more efficient to find people that have specific interests that you may have and also have mutual connections or go to the same school as you or have the same job as you or come from some kind of mutual connection.
Okay.
Yeah. I think the pain point that Facebook solves is the ability for businesses to target consumers, right? Because businesses want to advertise effectively, but they don't have the data and they are not able to target these ads very effectively. But what Facebook does is it gathers all this data and then allows businesses to target ads very specifically. And so people using Facebook aren't really the customer, they're more like the product, and the advertisers are the customer. They're solving a pain point for those businesses.
That's right. So if you think about it, the real pain point that Facebook is solving is, I mean, the social connection thing is like certainly there, right? Like people are on it. They spend a lot of time on Facebook and its associated platforms, but we don't pay for it. And indeed, as Ben says, the real pain point is that advertisers want to figure out how to get more efficient ads, right? There's an old joke that, every ad, like 50 cents of every ad dollar that's spent is wasted. But the problem is nobody knows like which 50 cents it is. And what Facebook does is they leverage the data that you and I freely give them, right? And they use that data to effectively sell it to advertisers who then can more effectively target us. And by the way, this isn't necessarily a bad thing, right? Like, I don't know about you, but I'm kind of glad that I don't get advertisements for products that I have zero interest in, right? It's kind of just a waste of my time. And invariably, I don't know if any of you have ever done this, but you're flipping through Facebook or Instagram or whatever, and there's an ad for something that you actually think is really cool, and you click on it and you buy it and you use it, and it adds like a ton of value to your life, and you're like, yeah, that was actually pretty nice. So there is value, right? That's being created for these advertisers. And Facebook has created this interesting kind of auction model wherein advertisers bid on those different keywords or demographics of individuals. And so the companies that value that demographic the most and those keywords the highest, they end up paying the most for it. And that's how Facebook's able to extract quite a bit of value from this pain point, right? The one thing I just want to add there too is here's something you should think about. If you are not paying for a good or service that you are using on the regular, you are not the customer, you are the product. Think about this, test it out in your life. You'll see that it's probably more true than you'd care to admit. But it is what it is. And there's a really great product or a really great article that kind of goes into this in depth called You Are the Product, worth a read if you want to check it out. All right, let's talk about Lyft. So what is the pain point that Lyft solves, and who is their customer, their primary customer? You could also substitute Uber here too, if you know, if you're not familiar with Lyft.
Lyft makes transportation more efficient for individuals trying to get from point A to point B. Maybe they don't have access to a vehicle, or maybe they're under the influence, can't drive. Yeah, that's kind of the main point.
Okay, so you're going from point A to point B. They make it more efficient. Question though, who actually gets you from point A to point B? Is it Lyft? They have a bunch of employees out there carting people from point A to point B?
Well, it'd be the Lyft drivers, which are hired through the Lyft app, right?
By who? Who hires them?
The
Does
software.
Lyft hire them, or does the passenger effectively hire them?
Oh, well, I guess the passenger.
Yeah, the passenger is hiring them, right? So who's Lyft's customer then? If it's not the passenger.
The drivers.
Wouldn't Lyft?
Sorry, Ben.
Yeah, so it's the driver. And what is the pain point that the driver faces?
Finding people to
customers
ride.
Transport.
Finding people to ride. What did you say, Miranda?
Yeah, just the same thing, like finding customers to transport.
Okay, so think about it this way. What is the bigger pain point? You come out of the bar and you've had you've hit back a few too many and you need to ride home. What your alternatives are? You could walk, you could get a friend to pick you up, right? You could call a cab, right? You got a lot of different options, and it's valuable. Or you want to start a taxi business from nothing. You've got a car and a driver's license, and that's about it, right? Think about like how challenging it would be without Lyft or Uber to start a taxi business full on from scratch, right? You got to have a car, driver's license, but then you got to like get customers, which is insanely hard. You got to have the insurance. You have to have payment mechanisms. So when people pay you, right? Like you've got to have like the maps. There's so many things you got to have. You might need to have like certain licenses, et cetera, et cetera. So what Lyft has done that's really interesting is they have built like a taxi service in a box that is so easy that like people that don't even like really speak English from other countries who have only been here like a month can be up and running and generating income as a taxi service, right? And working for themselves. And all they have to do is download the app, run through a background check, right? Make sure that they're not a serial killer, and they can start generating money. In fact, they don't even need to own a car because Lyft will connect you with a company that will rent you a car. So they make it like super easy to start a business. And if you look at the way they charge for their service, right? They charge a commission or in other words, a percent of the ride, right? And there's basically a commission for giving the driver a rider, right? And then they charge some like other fees for being on the platform. And those are effectively paid by the driver, right? And taken out of what you would otherwise pay to the driver. So the passengers end up being customers as well in like an indirect way, in the same way that Facebook still cares about users, right? Facebook still needs users to come on the platform, engage, post content, et cetera, because they need that data and they need the eyeballs on their site in order for their advertising model to work. So they still care about users. but that's not where they're generating revenue. And Lyft is basically saying, like, we got to be really good at advertising and getting passengers onto our platform, because if we don't do that, then we're not really creating value for our drivers. But it turns out that, like, Lyft, by aggregating all of these drivers, can do a more efficient job than if you had like 1 million drivers all trying to set up their own businesses and advertise. So can you imagine how noisy and obnoxious it would be if, you know, there were 1 million taxi companies all vying for your attention, instead of just, you know, 2 effectively. So anyways, some business models, sometimes, again, just like McDonald's, it's not as obvious as it might seem. And you got to go a little bit deeper. So you got to ask, like, who feels this pain point the most? Who's paying the money? Who's writing the checks? Is kind of another big question that oftentimes I'll ask to really understand who's feeling the pain point. Sometimes it's like, oh, well, the pain point is being felt by somebody in this side of the company, but it's being paid for by this other side of the company, and they're not feeling the pain point. And so there's that disconnect where maybe, like, yeah, the person that feels the pain point really needs it, and but they just don't have any ability to pay for it. And the people that are paying for it, they're not feeling the pain point, so it's not a high priority for them, right? And those types of things, like, can really break down deals. So really, you gotta go deep, and you gotta think about, what's the pain point? Who feels it? Who's writing the checks? Et cetera, et cetera. Okay. So here's a question that I really like to ask in our trainings, and that is, given all the stuff we just talked about, what is business strategy? So, like, you know, your niece comes up to you and she's like, I keep hearing this term business strategy. What does it mean? What's business strategy? How would you explain it? Timothy?
Yeah, so I think the way that I would explain it to, you know, my 5-year-old niece would be like, it's a path that a group of people take in order to best serve the community and its purpose.
Okay, so it's like a plan.
Mm-hmm.
Strategic
Exactly.
plan. Alexander, what do you think? You there? You got your hand raised.
Oh, sorry, that was from the previous
Oh, sorry.
previous discussion. I will unraise it. But I would agree with Timothy in terms of it's a path, and it's a plan of materializing the and closing the pain for the customer through the means accessible for the business owner.
Okay. Who else? Any other thoughts? Are we going to coalesce around that? Okay. Here is how I define business strategy. It is the art of creating monopolies. Now, monopolies are kind of a dirty word. I get that. But I want you to suspend belief for a moment, suspend your prejudices against the word. In economics, any of you that have taken basic, like 110, 101 economics, economics says that basically everything reverts to commodities over time. Right? No company has an advantage over any other, and like profits, like real profits effectively go to zero. Now that doesn't really happen in the real world. And the reason that doesn't really happen in the real world is because companies work really, really hard to not be monopolies because they don't want their rents. They don't want their profits to effectively go to zero. They want to be different. They want to be monopolies in some degree or fashion. And if you look at venture capital, generally speaking, there are, like, every single company that is successful is a monopoly, and the degree to which it is successful, the more monopolistic it is. So the more successful the business, the more monopolistic it is. Another way to think about this is they are the only ones that are solving that massive pain point that people have. And there are a lot of ways in which that they can create monopolies. But if you think about Google and Facebook and Amazon and Uber and, you know, to a certain extent Lyft, although, you know, at a lower extent. You even go to like other businesses that aren't like consumer facing. So if you look at companies like Oracle, right? All of them are monopolies in one shape or form, right? Salesforce is another great example, right? Like they're pretty much like there's a bunch of little CRMs, but then there's Salesforce. And the reason this is important, particularly when it pertains to venture capital, is that you don't have 100 years to build the next IBM and generate a return. You only have 10 years in most cases to generate a huge home run for your investors. And so you need companies that can grow very quickly and can establish themselves in a place where they can generate huge profits in a relatively short time period. And monopolies are really good at that. So monopolies, they can't charge whatever they want because they still need people to have the ability to pay, but they can charge substantially more than commoditized businesses, and they can generate kind of the maximum amount of profits through their monopolistic power. Now, there are basically two ways to become a monopoly. There is what's called differentiation, which is you just try to be real different, right? And the other is low cost. Now, differentiation, I want you to think about that in terms of it's different for, well, basically the business has figured out how to appeal to different types of people. Apple is a great example of a clear differentiation strategy. And the reason for that is people are willing to pay more for Apple simply because it's got that Apple logo on it, right? There could be a lot of other reasons, like, oh, well, you know, I really like, you know, the blue bubbles in my text messages and like green's ugly, whatever. It could be like, yeah, but like the metal, sleek, sexy, you know, products, whatever, or I just really like the UX. It's just so easy to use and not complicated, and, you know, it just works, and all their devices work together. All those things, those are all great. But there's nothing in there that like you couldn't get from somewhere else, right? Like you can buy a phone, an Android phone, that in some cases will do like way more things and way more flexibility and better hardware than an Apple device. But people don't want that because they want the nice little Apple logo, right? And Apple does a lot of things to, like, once you're in, to really pull you in and keep you in, right? It's like, well, I bought all these apps, they only work on iOS. Like, I'm really invested in the app ecosystem here. And I love that, like, my phone works with my laptop, which works with my TV, right? Like, and they're all integrated. And so they do a lot of things that really, like, lock people in and become basically a monopoly, right? It becomes really painful to switch from an Apple device to an Android device. It's painful from the perspective of, like, not just, hey, I've got all these apps and so forth, but it's also painful in some cases from a social perspective. It's like, oh, I don't want to be the person with the, like, the green bubbles, right? So anyways, but because of that, Apple is able to charge substantially more for their hardware than anybody else, right? So Apple is making, I can't remember what the latest numbers are, but they're making like 2x the margin of most hardware, electronics hardware manufacturers, right? And that's because if you are somebody that has to buy Apple, you're going to buy Apple no matter what. And like, yeah, you're going to choke down the like $500 headphones, even though you could buy like perfectly good Bose ones for half that price that are just as good. Like, there are people that are like, no, it's Apple, I'm going to buy it, right? So that is the idea of differentiation. It's like, hey, we've locked into these customers and they're going to come and buy from us because we're offering kind of exactly what they need and we're solving the pain points they care about. Another good example of this that I like using is like in the airlines. Another like easy way to describe this: Southwest versus Delta. Delta is really good if you're a business traveler, but it's not always the cheapest. Southwest is usually cheaper, but you don't get any of the amenities that you get with Delta. So it ends up being a really good solution for like families that are looking for a low cost. Delta is really good for if you need lounges, you need first class, you need meals on the flight, you need lay down seats, you need to fly international, right? Like all those things that are a little more business focused. You can't get those things on Southwest, right? It's a different product. And so you end up going to Delta if you're a business, and if you're a family trying to get like 12 people to Disneyland, you go through Southwest, right? And that brings me to the other side of ways in which you can differentiate your business, and that is having a low-cost strategy. Now, low cost is less about differentiating who your customer is and more about like your cost structure to provide that good or service. So Southwest is a great example of this from the perspective of they don't offer first class. They don't advertise on other sites. Like you have to go to southwest.com to buy your tickets. They don't offer meals on flights. They don't let you pick your seat. They right? Like they don't, they're basically like buses with wings. But because of that, oh, and they also don't have the best gates at airports, right? They're always like the furthest away, crappiest gate. You got to walk 10 miles to get there, right? Because they're paying the least possible for those gates. Their cost structure is really low, and it's really hard for other companies to copy their cost structure. And that is how they create this competitive advantage, right? If Delta wanted to get the same low cost structure that Southwest has, they'd have to get rid of their lounges. They'd have to get rid of first class. They'd have to stop advertising. They have to get rid of food on flights, right? They'd have to start competing for like the crappy gates and give up like the really good ones that are like right outside of security, right? Like all of those things. When they would do, if they did that, they would lose all of their customers that they really like having, these business customers that pay them a lot of money, right? So it's really hard for them to copy Southwest. And that is what low cost is all about. It's about making it really hard for other companies to compete against you. And by the way, you can have both. You don't have to just do differentiation or low cost. So if you think about Facebook, Facebook is a great example of both differentiation and low cost. Everybody's on Facebook because everybody's on Facebook, right? It's highly differentiated. Like there's no other platforms out there that everyone is on, right? TikTok, kind of making a run at them. But even so, like the order of magnitude of people that are on TikTok versus Meta is like, it's not even close still. So they've got differentiation, but think about it. Like if you wanted to start a social network tomorrow, how costly it would be to get the same scale as Facebook, right? To build up to get all of that user, or another way to look at it is like, let's say you wanted to compete with Facebook for those advertising dollars, right? You'd have to get all of that data. Facebook is effectively getting all of our data for free. And if you wanted to set up a site, you would either have to compete with the social side of what Facebook does, or you'd have to figure out some other way to get data for free from customers. And that's really hard. And so your alternative is you pay customers for their data, which would be insanely expensive. So Facebook has this like huge cost advantage when it comes to like getting customer data because we give it away for free. And then they have this like really great differentiation advantage where like they're kind of the only game in town. And so like, yeah, you could go to like MySpace, which has a lot of the same functionality, but there's nobody there, right? And so you end up coming back to Facebook. All right, so I have this chart up because I also like kind of running through some examples of shoes, because I think it's another way to like think about different brands and their strategic focus. You also have this concept of like, are you going after a niche market? Are you going after a broad range of buyers? So let's imagine like we're looking at shoe companies. Anybody have a shoe company that would fit a broad differentiation strategy?
Like New Balance.
Okay, maybe New Balance.
Nike.
Any other suggestions? What?
Yeezys or Nikes.
Yeah, so Nikes, right? And the reason why Nikes fit really well with broad differentiation is because like Yeezys are cool, but they're only really kind of like one style of shoe for the most part. But Nikes, like you got track shoes, hockey, soccer, right? Dress shoes, running shoes, track shoes, like, you know, golf shoes, like tons of different shoes, right? And they're all pretty high quality, right? If you buy a pair of Nike shoes, you know, you're going to feel pretty good that they're pretty well made, and they're not going to be super cheap either, right? Like you're going to pay a decent amount for them. What about focused differentiation? So rather than offering kind of this broad range of products that are high quality, what if you just offer a few?
Maybe like Golden Goose.
Okay, Golden Goose. I don't know that brand, but what do they do? What kind of shoe? Tell us about the shoes.
It's like very specific. It's like an Italian designer shoe, but it's like
Okay.
it basically looks kind of like scuffed up, but also has like a bunch of glitter on it, and it's
Okay.
kind of like the gist of the shoe.
How much are the shoes go? How much do they go for?
I think they're around 600.
Okay. Yeah, that sounds like a good example. Any other examples?
I would say probably any specific sport shoes. So those who, unlike Nike, don't cover all sports but only do one. So, for example, like Crown ballroom dance shoes, they only do ballroom dance shoes. This is their niche, and they don't go beyond that particular sport.
Yep, and they're probably really high quality, right? It's like
Very
if you're
high
in
quality.
dance, you gotta
Yeah.
have them. Yep.
Yes.
Yep.
There are
Yeah.
those like, all the champions would wear, and then everyone would dream about that one particular brand.
Yep. Love it. Any other suggestions?
Allen Edmonds.
Allen Edmonds. Yep. So Allen Edmonds makes really high-end men's dress shoes. They range from like $300 to $1,000 a pair, and they can last you your whole lifetime, right? But they only make dress shoes. They only make like men's dress shoes. Yep, Taft is another similar brand to Allen Edmonds. The other one too that I like for women is Jimmy Choo's. So really high-end stilettos, and other heels. So yeah, high-end, really narrow focus. They typically charge a lot for those shoes, but they're also very high quality, and they appeal to a very specific demographic, right? What about focused low-cost strategy? And I'll give you an example. If you can name a brand, you're probably wrong. But what would it be?
Would it be like no-name brands at grocery stores?
Yeah. Like, you know, those like flip-flops that like, it's like a slab of foam with like a little like plastic toe thing. And there's no brand, right? And they're like $1 for a pair. That is like classic focused low-cost strategy. You walk down like the shoe aisle of Walmart. There are companies where they just make one pair of shoes and they make them as cheaply as they possibly can, right? Super low cost. It would be really hard for Nike to make a comparable shoe as those brands at the same like cost basis, because they would have to just basically zero in and focus on like just making that one type of shoe, right? What about overall low cost leadership strategy? There was a store that was like the perfect example for this. forever, and they went out of business a few years ago.
Well, I didn't have a store in mind, but I'm thinking Southwest.
Shoes?
Oh, no.
So anybody familiar with the brand Payless shoes? So
Yes, I was just about to say that.
There you go. So Payless, for those of you who aren't familiar with the brand, it was like these small stores, but they sold a bunch of shoes. They didn't sell every type of shoe, but they sold a lot of shoes. You get like tennis shoes, running shoes, dress shoes, sandals, you know, a bunch of different things, all pretty affordable. Not the highest quality, frankly, but, you know, kind of got the job done. I think today the parallel to this would be like the Walmart shoe aisle, where you can find all those same different types of shoes. No real brands, but for pretty affordable. What about best cost strategy? There is a brand that I think is like perfect for this one.
I'd say Adidas is pretty good because they do a pretty good job of differentiation, applying to broad markets.
Okay, Adidas isn't a bad one. They're a little bit closer to like a Nike though, right?
Yeah.
This one starts with an S.
Saucony.
Oh.
Skechers.
Skechers. Right. So think about Skechers. Like they offer a range of stuff like dress shoes, walking shoes, whatever. They don't offer everything that like a Nike offers. Their quality's probably not as good as a Nike. It's not as good as a Nike, but it's better than Walmart, right? So it's kind of like right in the middle, like this best cost strategy. All right, cool. Think about your company, think about like what their strategy is and where their focus is. And then think about, this can be helpful when we talk about competition, because if there are a lot of people that are doing like broad differentiation strategy and your company is doing broad differentiation strategy, that may not be the best place for them to be, unless of course that's where all the consumers are, right? So think about like, these can be helpful in terms of breaking down what the strategy is of the company and where it's facing competition. All right, let's move on to, well, actually, let's pause there. Any questions on strategy, pain points, business models, any of those fun things? All right, I'm glad that I nailed it and you're all experts. All right. So I love this quote from Ben Horowitz. For those of you who don't know Ben Horowitz, he is one of the founding partners of Andreessen Horowitz, which is arguably like one of the best venture capital funds today. Certainly one of the largest. And he was quoted as saying this years ago when they first started the firm. He said, "We invest in college dropouts with insane ideas going after tiny markets with no way to monetize." Does that sound like a winning investment strategy to you all?
Definitely not.
Definitely not. So, can any of you think of a business that sounds like this?
Facebook.
Basically every major tech company from the last 20 years.
Not always, right? There are a lot of tech companies that are founded by people that are not college dropouts, that are experienced technologists operating big markets. So they were backers of Airbnb a little bit later. They weren't early backers. But what I love about, and this is the original logo, by the way, of Airbnb. But think about Airbnb when it started, right? They weren't college dropouts, but they were kind of a ragtag crew. And the idea was insane, right? Like people are going to sleep on other people's couches and they're going to like pay for the, you know, the privilege of doing so. And like, how big is that market really? Like how many people are really willing to pay to sleep on somebody else's like couch? right? And how do you monetize that, right? Like who's actually willing to pay to sleep on the couch, right? And if they're only willing to pay like $10, like how do you make any money off of that? But what is Ben really saying here? Is he really saying that they invest in tiny markets with no way to monetize?
No, he probably is investing in big markets, but at first, it's hard to see what the product or the service offered is. So it's a matter of like believing in it.
Yeah, I mean, they're investing in huge potential markets. And if we go back to the beginning of my presentation of the training, when we talk about pain points, what I think he's really getting at here is we invest in massive pain points that aren't being solved today by current markets. And we're not worried about monetizing it because we know it's such a big pain point. We'll figure out monetization eventually, right? Because people will just be desperate to have this pain point solved. Now, Airbnb always has this like parallel market, right? That you could point to, hospitality, hotels, etc. And I used to like for a long time really think like, well, really like, it's kind of disingenuous to say that like the market was small because like you could always point to hotels and that's really what they were helping solve. But the more I've thought about it over the years, the more I've realized that really Airbnb in particular solves this like pain point that hadn't really been solved before. And it solves it on two fronts. So just like Lyft, who's the primary customer of Airbnb?
The homeowner or the property
homeowner,
owner,
right? They make it really easy for you to rent out your home, especially on short-term rentals. So that's a huge pain point where I've got this huge asset that's just sitting there, right? I should be able to like take that asset and monetize it and generate income from it, but I can't do it by myself. I need a platform like Airbnb in order to pull it off. So that's one pain point. But the other pain point that I think Airbnb I don't know if they fully appreciated this when they started the business, but they essentially drove down the cost of travel. And I think part of the reason there's been a lot of talk about how millennials prefer experiences over things. And to a certain extent, Gen Z is in a similar boat. I think one of the biggest reasons why that is the case is because millennials, for the first time ever, were able to travel very cost effectively through platforms like Airbnb. One, airline travel kind of got to this point where like you could buy airline tickets fairly cheap. And two, you could stay at somebody's Airbnb for tens of dollars instead of hundreds of dollars. And what that did is it's not that like Marriott and Hilton and Hyatt like went away. Like I'm staying in a Hyatt right now in Atlanta while I do this training. Like these hotels continue to do well and grow and be big and successful and so on and so forth. Airbnb did not put them out of business, which is what a lot of people thought would happen. What it did is it said to all these people that wanted to travel, hey, guess what? Now you can actually afford to travel because you don't have to shell out $1,000 to stay at a hotel for a week. You could shell out $300 to stay at a house that has multiple bedrooms and a full kitchen, right? It drove down the cost of entry of travel. And what that did is it opened up this huge nascent market that was completely untapped. And so when you're thinking about markets, sometimes they're tiny and you can look at adjacent markets like hotels and say, hey, there are a lot of people that travel and that need a place to stay. But you can also sometimes look at it and say, hey, there's this like blue ocean opportunity where there's this pain point that nobody has really appreciated yet. That that this company has figured out how to solve, and it's gonna create this massive market. And it's gonna, people only have a certain amount of time and attention. So if you think about like all the businesses that have been negatively impacted by Airbnb as people have shifted time and dollars over to Airbnb, it's things that you wouldn't necessarily think of. It's like, how many people go to malls anymore for entertainment, right? How many people buy things at malls, right? Malls have been basically decimated. And you could say it was because of Amazon, but you might also say that it was because of things like Airbnb, where people have shifted their time and attention to these other opportunities. Now, here's the cool thing about Airbnb that I just want to hit on before I move on. And it's this concept in venture capital that we talk about sometimes called an earned secret. And when Airbnb was started, the way it got started is the founder was having trouble paying his rent. So like clearly not like, a super wealthy, super successful entrepreneur, struggling to make his rent. And there was a big conference coming to town and all the hotels were totally sold out. Couldn't get a hotel in the city. And so he was like, I wonder if I put an ad on Craigslist that I would let people sleep on my floor. Buy some air mattresses, people can sleep on my floor. I wonder if I could get anybody to sign up. And lo and behold, he got a ton of people that were interested, rented out his apartment, rented out like some friends' apartments, I think too, put up people on air mattresses, made some money, and realized there was an opportunity here, that people were indeed willing to pay money to sleep on somebody's floor. And that was this like earned secret that nobody else knew, which was, hey, we can provide this service. And even though it's going to sound crazy to everybody else, which the best ideas often do seem crazy, we know there's a market here. Like people are willing to shell out money. And there are people like me that are struggling to make rent, struggling to make my mortgage payment, whatever it might be, that would be willing to let people sleep on my floor or in my bedroom or whatever it might be. So think about, and this brings back, like, we're going to talk about this next week when we talk about teams, but like, does your team have this earned secret? Are they the right team member for the company that you're evaluating? Okay. So let's talk about big markets. I know I just said that like markets sometimes are small, but at the end of the day, VCs do care about investing in really big markets. And even with Airbnb, the people that invested, they like could see this vision of like, hey, if this works, this could be massive, right? Huge, huge, huge market. So why do VCs invest in big markets? And how big of a market does it really need to be? What do you think?
Well, I guess speaking generally,
yeah.
I guess generally, like the bigger the market, the bigger the potential returns. Like if Facebook goes to every person in the US, then there's a lot of revenue to be made there.
Yeah. Yeah. So big markets, potentially big businesses, like big revenue, big businesses, et cetera, et cetera. So if we run through the math here, let's say you have a $100 million venture fund, which in today's standards is a little small, but we'll just go for it for now. You'd make 10 investments, $10 million each. Assume you get 20% ownership in each company, which is kind of like the target for a Series A fund. If you want to return your whole fund on one investment, then how much would that company need to sell for? Well, 10 investments, 10 million, you own 20%. So I need to return $100 million. So this company has to be worth $500 million, right? If I own 20% of a business worth $500 million, that's worth $100 million. That returns my fund. Okay. All right. So let's say in order to get to a $500 million business, your company probably needs to be generating about $100 million in revenue. If you operate in a $1 billion market, that would be 10% market share, which would be insanely hard to achieve, but possible, right? sometimes people are like, oh, it's only 10%, but 10% is actually really, really challenging in a market to acquire that much share. But it is doable. It's possible. Like if you are solving a pain point better than anybody else, right? Then getting to 10% market share is possible. And if you can do that, then you're generating 100 million in revenue times 5x, which is valuations ebb and flow. And so but 5x is a general like good rule of thumb for a fast growing business. You can get to a $500 million exit. Now, in the last few years, businesses that do 100 million in revenue are usually valued over $1 billion. But prior to that, they were valued closer to like 5x. I don't know where we're going to go in the current market. I'll tell you right now, though, that we're closer to that 5x for valuations than we are at 10x, which is causing a lot of entrepreneurs a lot of frustration and pain at the moment. But that's kind of where it's been over the long run. So, but point being, your company's got to operate in at least $1 billion market in order for kind of the returns for your fund to work. All right, let's talk a little bit about TAM, SAM, SOM. This is something that I'm sure you all have heard about, maybe seen in classes, et cetera, et cetera. I just think it's helpful when you're thinking about your market and market size and potential and all of those other things. So one of my favorite ways to talk about this is with like a Chinese restaurant. So a TAM, your total addressable market, this would be like everybody, let's say you have a Chinese restaurant in downtown Salt Lake City or downtown San Diego. Your TAM is going to be like everybody that eats food, right? Within like a reasonable distance from your restaurant. Everybody that eats food, right? That's your TAM. Theoretically, you could get, because you provide food, if you got everybody that eats food, which is everybody, right? Within that zone, that would be your TAM. Now, as you think about it, that's like totally unreasonable for you to assume that you would get everybody to come in and buy food from your Chinese restaurant, right? Especially in like any given moment. It's just not, it's not possible. And that's why you break it down to your SAM and your SOM. So your SAM is based on your current business model, and your SOM is going to be based on the practical limits of your business model. So your SAM, if your business model is Chinese food, we sell Chinese food, and we sell Chinese food, you might do it as like delivery, you might do it as fast takeout, you might do it as a sit-down restaurant, right? Those are all like slightly different. But if your model is like, we sell Chinese food, now you're going to take everybody that like eats food and you're going to narrow it down to people that like Chinese food, right? And you might drive it down even further and say, we're downtown. So really like we're targeting people that are downtown that like Chinese food, right? So there's a pretty decent shrink from TAM to SAM. Then you've got SOM, and this is based on the practical limits of your business model. So if today the practical limits of your business model is that like we have a sit down Chinese restaurant, we only have like 20 tables, that's going to limit how many people can come through your restaurant, right? And so the way you expand from your SOM to your SAM then is you open up more locations, right? You expand those practical limits of your business model. Now, that's fairly easy to think through with like a restaurant. When it comes to technology, it could be that, hey, your TAM is like, if we think about Airbnb, it's like everybody that needs a roof over their head, right? Or you could narrow it down a little bit and you could say everybody that needs a roof over their head that's traveling, right? And then you have your business model, which is like, all right, everybody that's going to fit within this like peer-to-peer thing, right? Where I need a place to stay, but I'm willing to go, like maybe I need a kitchen, or I need multiple bedrooms, or I need whatever, and I don't need a place that's really convenient, really easy to accept, like really accessible. What's the other thing I was looking for? Like all the reasons why you would rent from a hotel. Like for me, like I am staying at a hotel because the location is better. It's more convenient. It's easier to check in and out. I know exactly what I'm getting. There's consistency. There's a lot of convenience factors. And for business, it makes a ton of sense. When I travel with my family, I tend to do that more through Airbnb, because in that case, I'm looking for different things. I'm looking for an experience. I'm looking to reduce cost and pack in as many people. I might be looking for a kitchen because, maybe we're going to make our own meals. Could be a bunch of things, right? Or maybe I want certain amenities that would be way too expensive. So for example, I own a condo in Mexico on the beach. There's a Sheraton next door. For the same price per night, you can stay at the Sheraton and get a 1-bedroom queen, right? Looking out over the ocean, like great location, blah, blah, blah. Or you can stay at my place, which is 2 bedrooms, 2 baths, full kitchen, beautiful pools, all this stuff. Right. But what you're not going to get is you're not going to get all of the convenience factors that the Marriott has. Like I don't have restaurants on site. I don't have, ease of check-in. Right. I try to make it as easy as I can, but it's not the same. I don't have cleaning every single day with fresh sheets. My place is not immaculately like ready to the same degree that a Marriott is. Right. So like there are different standards and they appeal to different people for different reasons. So those could be like some of the things that are based on your current business model. And then you shrink down and you say, okay, based on the practical limits today, so for Airbnb, it's like, well, today we're only in San Francisco, but tomorrow we open up New York, and the next, month we open up Seattle. And so over time, that sum starts to grow into the SAM. Now, it's very rare that SAMs will grow into TAMs, but ideally, right, you have that ability of your SOM growing into your SAM. And so that's why SAM and SOM end up being really valuable and important. Okay, any questions on SAM, TAM, SAM, SOM? Okay. So when you're evaluating markets, these are just some things that I think are really helpful, because part of it is like, you're evaluating where a market is today, but you're also, as a venture capitalist, you're trying to figure out where markets go in the future. And so these are different things that I think are helpful to be thinking about when you're evaluating market and how it's going to evolve over time. So one is demographics and population. If you look at like the baby boomer generation, right? Huge generation. There's now all these things that are happening, right? Boomers are getting older. They're demanding more healthcare services. They're retiring. They're moving to places like Florida, right? Like you're seeing markets for real estate in Florida, like start to spike, and in other parts of the area start to decline a little bit as people move. You're starting to see as boomers die that they're shifting. There's this huge wealth transfer that's occurring. There's a lot of different things, markets that are being drastically impacted up and down just by the population and demographics of the boomer generation. Same thing with millennials, and so forth. Another could be like technological advances. So pretty much most of the consumer-facing technology companies the last decade would not have been possible without these supercomputers we have in our pockets. Right? This phone is like infinitely more powerful than the laptop I had when I was in college. And because of that, you can have things like Uber and Lyft exist. Before that, it wasn't possible, right? For those apps to exist, because they required so many things, so much processing power, storage, GPS, screens, app stores. The list goes on and on and on of all these like technological advances that were required for a company like Uber and Lyft to take off. And now Uber and Lyft have taken the taxi market from being $11 billion in size to being like over $100 billion in size, right? So that has driven these market shifts and these market growths just by the fact that technology has enabled new products and services to solve pain points that have always existed, but just haven't been solvable. Could be the product life cycle. So diapers, right? There hasn't been any innovation in diapers for years, but when diapers first started out, that market grew a ton and now is pretty tapped out. It's not really growing much anymore. It's become this stable, saturated market. And so when you're looking at like diapers, you probably can pretty easily and accurately forecast what the market is going to look like next year and the year after that and the year after that, because it's pretty saturated and stable. There are other markets that are new and they're growing really fast, like virtual reality, for example. There could be external factors that impact things, so like laws, and those can work both ways. In some cases, laws come out that restrict markets. In other cases, laws either disappear or promote markets. So cannabis is a good example of that. There are laws now allowing cannabis, and that market has grown a tremendous amount. There could also be laws that create artificial markets, right? So, trying to think what's a good example. I mean, like there could be things where like you need permits in order to operate in a certain industry, and so there's a whole industry that pops up to support permitting. Network effects. So that would be like the rise of social. Social media never really existed before Facebook, but as Facebook started, then people got on, and then more people got on because those people were on, and more people like had to get on because they were on, and they just kind of grew kind of exponentially quickly. The key thing with a network effect is that the product or service becomes more valuable as more people come on. So the next person that comes on brings value not only to themselves, but to everybody else that's already there. And then it becomes even more valuable for the next person and the next person, and the next person, which is why companies that are network effect driven tend to scale super, super fast. And then you've got like customs and culture that like play this whole like interesting angle. One of my favorite examples is in China. There was a huge drop in the birth rate in 1999. And researchers couldn't quite figure out what was going on. You had this like pretty steady growth, and all of a sudden this huge drop. And then in 2020, sure enough, the huge spike that basically made up for the drop. And what happened was the year 2000 was the year of the dragon in the Chinese calendar. And not only was it the year of the dragon, it was the year of the golden dragon, because there's a calendar of like the animals, but then there's like this whole other like elemental calendar that's like earth and gold and so on and so forth. And so it was like the best possible year from like a, good luck perspective to have a baby. And so a lot of people are making decisions like, I'm not going to have my child this year, especially in China where I only get to have one child at the time. I'm going to save that child up so that they're born in the most, the luckiest year, right? And so culture can have these like huge impacts on markets, right? That year in 1999, the demand for baby products was a lot lower than it otherwise would have been. And in 2020 was a lot higher. So thinking through like different culture and customs and how that's going to impact markets can be really important. All right, let's talk a little bit about competition. Just rolling right along. So how many of you have heard of Porter's 5 forces? Probably a lot of you. So here's my big axe to grind on Porter's 5, is that most of the time people get it wrong. They think Porter's 5 forces applies to a company. It does not apply to a company. Porter's 5 forces applies to an industry, specifically a value chain. So we're going to talk about this because Porter's 5 Forces turns out to be a really great framework for evaluating competition and helping you identify potential competitive threats. So let's say you have a company that makes a ham sandwich. It's in the manufacturing phase of our value chain. Now, value chain is just the steps at which value is created. So if we're making like notebooks, I'm going to start with trees. I'm going to start with land and then trees. And then those are going to get turned into paper pulp, which are going to be turned into big reams of paper that are going to be turned into notebooks, which are then going to be turned into notebooks that will be shipped off to retailers that will be sold to you, right? That's your distribution. So raw materials, manufacturing, distribution are kind of the three main categories for most value chains. So in our example, we've got this ham sandwich. We're manufacturing the ham sandwich. We're buying bread from our suppliers, and then we are selling our sandwiches to restaurants who are then going to distribute it to our customers. Our suppliers have supplier power. If there's only one maker of bread because they have like the exclusive license or, a patent, or the only ones that know how to make bread, or they control the whole flour supply. I don't know what it is. They are going to have a lot of power over us, right? And on the buyer side, if there are lots of buyers that we could sell our sandwiches to, then they're going to have relatively low power over us. Or if there's only one buyer of sandwiches, they could have really high power over us, and vice versa with the bread side. So that's how these buyer relationships, and when I say power, what I mean by that is if I'm the only one making bread, I can charge a lot more for that bread, right? Because I'm the only one that you can buy bread from. And on the buyer side, if I'm the only one that will buy your sandwiches, I have more power over you. But if there are lots of other people that buy the sandwiches, then if they're not willing to buy the sandwiches at the price I want, right, I can go to somebody else and maybe they'll pay me more for those sandwiches. So buyer power in that case gets diminished. Rivalry refers to other companies that are making ham sandwiches. Maybe they're making turkey sandwiches, but they're solving kind of the pain point in the same way, right? Sandwiches. And then you've got threat of entrance. So this would be how difficult it is for somebody else to make a sandwich and bring it in. In some cases, it's really hard. In some cases, it's not that hard. In this case, it's not that hard to make a sandwich. So threat of entrance is probably pretty high. And then you've got substitutes. And substitutes would be companies that reside in value chains that are solving the same pain point in a totally different way. So in this case, I've got pizza as an example, right? If the pain point that needs to be solved is I need portable nutrition that I can eat without utensils, sandwiches fill that need, but so do slices of pizza. And all of these represent potential competitive threats that you need to be worried about. Suppliers could, how hard is it if you are making bread to cut 2 slices of bread, throw some meat in the middle, and now start competing? Same thing on the buyer side. If you already have access to all the customers, how hard is it to skip this middle manufacturing side, go buy the bread directly from the suppliers, cut it in half yourself, throw in some meat, and start selling it to your customers? So those can represent big competitive threats that you need to be aware of, both from your suppliers as well as your buyers. That represents typically what we call vertical integration, which is a little confusing because in this case it would be horizontal. But vertical integration is they start moving through the value chain and snapping up pieces of it. You've got threat of entrance, which is how hard is it for somebody to come in? You need to be aware of like, hey, in the case of ham sandwiches, it's not that hard to start making sandwiches. So pretty much anyone can do it. But in some cases, like it is really hard to start it up, right? And to get access. And so being able to flag that and understand that's important. Rivalry is the one that everybody focuses on because it's the most obvious. And then substitutes is the one that always catches people flat-footed. And I talked about I talked about shopping malls earlier. You know what really killed shopping malls and movie theaters was probably Facebook, which came out of nowhere. But if you, again, you think about what is the big pain point that's being solved here by going to the mall or going to the movies, what is it? Is it really that you needed to go shopping at the mall? Like, how many people would go to the mall purely just to go shopping? Or how many people would go to the movie theaters purely because they wanted to see a movie? And how many people went to the mall and to the movie theaters because it was a social event and it was entertainment, right? And Facebook all of a sudden started competing for people's time. And it met that social need that they had, where they're engaging with other people, or at least they thought they were, right? It still scratched that itch. And so people stopped going to movie theaters and they started spending a lot more time online on platforms like Facebook. And if you're in the movie theater and you're at the mall, you're not thinking like, oh, Facebook is our big competitive threat, right? Because it doesn't seem obvious, but in reality, it's a substitute that's solving this pain point that you thought you were solving really well, or maybe you didn't even realize that was the pain point, which would be the worst case. But they come out of nowhere with a totally different solution that's solving that same pain point and end up crushing your business. All right. So with competition, it's helpful to understand like what are the factors that will determine who will win. And in order to do that, you need to spend some time understanding the customer and the pain point. Hence why I talk a lot about pain points. One of the questions I like to ask when evaluating a business, ask myself is like, why does this market even exist? Like, what's the fundamental reason it exists? Why do we have shopping malls, right? Why do we have movie theaters, right? Whatever the business is, like, why does this market even exist? What is the pain point that's really, really being solved? And thinking critically through all of the different pain points and then evaluating which ones are the biggest. And then looking at each company to determine who is solving that pain point the best, right? When you start thinking about it through those lenses, you're able to identify what are the factors that really matter and who is ultimately going to win. Now, in the Facebook versus shopping mall example, what's part of the reason Facebook wins is because if I go to the shopping mall, I might go with a couple of my friends and I might go like look around at a bunch of stuff and shop or whatever. And I might, hang out and have fun. But if I'm on Facebook, I can hang out with all of my friends all at once, theoretically. And I can see the things that they're doing. I can share the things I'm doing. I'm providing this entertainment layer plus social, and I'm doing it at a cost that's a lot lower, right? Because I don't have to pay to get to the mall, and I don't have to pay to get some food or go to the movie theater or whatever. Like, I can just go onto Facebook and I can check a lot of those entertainment and social interaction boxes that I have. So it does a better job of entertaining people. In your case, you might be evaluating an enterprise software company, in which case, talk to customers and understand how does the company you're evaluating solve their pain point versus some of the competitors and how they're solving their pain point, and which one is doing a better job of solving that pain point. One of the ways that I like representing this is through what we call strategy maps. So this is an example of a strategy map. They can be really effective when you're trying to compare lots of different businesses and how yours is strategically positioned versus the others. So what you'll do is you basically find two axes that represent the features that matter the most to customers. And so in this case, this was a company called Cuberhood. I actually ended up going out of business, but I still like this chart. And what they were saying is that like today you have, when it comes to like social media marketing and outreach, You have companies that provide point solutions, so like Buffer, and some of these others like DataSift and If This Then That and so on and so forth. But like they just do one thing. They do that one thing really, really well, but they just do one thing. And so if you want to be posting on social and online and so forth, like you gotta like kind of buy a bunch of these and kind of mush them all together, which is not a great user experience, but they're really good at their individual things. Or you can use Lithium, Sprinkle, Octopost, some of these others, Sprout Social, and those they're like they do it all, jack of all trades, but they don't do anything like particularly well. And in this case, what Cuberhood was saying is like, here's what we're going to do. We are going to build APIs that allow you to pull in the best of breed of all these other platforms into a centralized platform. So sorry, you're going to use all of these like individualized products that are really good at the one thing they do and bring them like through APIs, bring them into this platform, this one-stop shop where you can engage and interact with all these brands in one place. And so we'll have all the benefits of a comprehensive solution with the very best products from all these other companies. That was kind of their idea. But hopefully you can see how, these two axes, which is like single product focus versus comprehensive solution, and then closed versus open platforms, they felt like were the two most important things for customers making decisions. And in your case, it could be a lot of different things. But it's helpful to like start thinking about, as you're evaluating your business, like what are the two axes that really matter for determining who's going to win, and then mapping out where all the competitors sit and your company. And it may be that like other companies do a better job than your company does. Yours is not going to be the obvious winner, in which case you may not want to recommend doing that deal. All right, just some other questions worth asking yourself as you go through the process. So who are the top competitors? What factors will determine who will win? How is your company positioned against the competition? So when a customer chooses you, why do they choose you and not the company, the other competition, and vice versa? When they don't choose you, why are they going to the competition? That will give you some good insight in terms of how you're positioning yourself, right? Why do people buy Apple products versus Android products? Part of the big reason people buy Apple products is because they want to belong to this like Apple brand, right? Part of the reason why people buy Android products is because they want more flexibility, or they don't want to spend as much on their product, or they want certain features that Apple doesn't have, right? So there are different reasons why people buy one versus the other, and understanding why they would buy one versus the other is important. What are the company's sources of competitive advantage? So this can be either what makes it hard for other people to copy what they're doing, or what makes it hard for other companies to sell to the same customer. So like I said earlier, it's really hard for like Samsung to convince people that are already on the Apple bandwagon to switch over, right? It's really hard for them to keep, well, it's really easy for Apple to keep Samsung from selling to their customer because of all the things they've done to be different and create their brand and all those things. On the case of like what keeps it hard for them from being copied, well, Google has a much lower cost base for Android than Apple does for their operating system. And part of the reason for that is that Android is essentially open source. And there are lots of companies that are on the Android platform that are pushing code and new developments and all kinds of things that make it even better. And so Google doesn't have to spend as much money to make Android a really effective, really strong platform as Apple does to provide, like, to build their OS and keep it running and cutting edge and so on and so forth. Which is part of the reason why Android tends to lead on innovation, and Apple tends to lead more on quality. All right. So what does this all mean in terms of your due diligence that you need to do and prepare? So on your due diligence write-up, these are some questions that I would recommend focusing on. So when you're evaluating the business model, what is the pain point that's being solved? Who is the customer? Who is feeling that pain point and willing to pay for it to be solved? And how does the company solve the pain point? Get granular in there, really understand it, and be able to talk about it in a way that makes sense and is really clear to the investment committee, the judges, right? So that they understand, like, okay, this is the pain. I get it. Like, this is why this customer needs to have this pain point solved, because otherwise they're going to die, right? Like the quote we started with. And how does a company then, once they've solved this pain point for those customers, how do they monetize? How do they get value? How do they extract some of the value that they're creating for the customer? And be able to talk through that. And then ideally, like bonus points to a certain extent is like, how do they create this competitive advantage? What's their strategy? How do they have the potential to become a monopoly someday? The next one is market size. So how big is the market? How big is the TAM, the SAM, the SOM? Thinking through it. How did you calculate those? How quickly is it growing? And what is driving that growth? Another question you could ask yourself is like, why now? This is a very common question VCs will ask themselves when evaluating deals, is why is it like, why is now the time for this company to be successful? Why wasn't it before? Why won't it be in the future? And then the next piece is competition. So who are the top competitors? Who are the top companies that are solving that pain point that your customer has? Whether they're doing it directly by solving it in the same way that you are, or indirectly by solving it in a totally different way because they're more of a substitute. Who are the companies that represent a potential threat in that value chain, suppliers and buyers? And how hard is it for new entrants to come in? How is your company positioned against your competitors? So what do they do that's better or different? Well, ideally just better, right, than the competition. And then what are your sources of competitive advantage? Is it you have a lower cost structure than everybody else? It's really hard to replicate? Or do you have this like this market, this customer that's really hard to sell to because nobody else solves their pain point as well as you do? All right, that brings us to the end of the training. Any questions on anything that we've discussed this evening? Anybody still awake?
Yeah, my question would be like, where should we go to like look for, because I'm pretty new at this kind of thing, where should we go to look for like examples of good write-ups so that we can kind of pattern ours after it?
That's a good question. I mean, you can Google search investment analyses. I think the write-ups that you find on Start Engine, WeFunder, and Republic are not bad because they're going to cover a lot of these same things. But my hope is that you would go a little bit deeper than they do.
Awesome. Thank you.
Yep. Yes, Miranda?
Yeah, is the diligence write-up just as detailed or less detailed, or like how detailed does it compare to an investment memo?
Well, so your deliverable here is a presentation, right? And the presentation should be complete, but it's also something you're going to present. So it's going to be less granular in terms of the content that's on it. But you can address some of that granularity in the notes section of the presentation. And it should definitely hit on everything that's super relevant. It just needs to be concise.
Okay, thank you.
Yep. Federico?
So my question is, today we went over very successful companies, which makes it kind of easy to understand. But at the same time, will we cover examples of startups that are like, should we apply this those concepts that we saw today to startups in the next workshop, or are we going over established companies as examples?
So we go over
Do you get my
established
question?
companies.
Like,
we
do you
we
know
go
what I
over
mean?
established companies because it's easy, because everybody knows the companies, right? But the
Mhm.
same principles still apply to startups. So as you go through this, right, if you're looking at a company, then what is the pain point that that company is solving? Go talk to customers, gain an understanding of who the customers are and how the company is solving their pain point. How does a company make money? And be able to explain, those different pieces. Does that make sense?
Yeah, it does make sense. But the thing is, when we think about the business model for
Yep.
companies that we are used to know, it's kind of easier. But if you think about the market size, for example, just something that comes to mind, some AI software for machine learning. How can you? So that's kind of a tricky market sizing question, because that could be automotive companies, that could be I don't know, like many other industries, and so that makes it way harder to assess that characteristic for a startup versus a known company. You know what I mean? So will we cover
Yeah,
that kind of
but
things,
that's
or
also maybe a red flag for you, right? If you're looking at a company and you can't define who the customer is, because it's like could be everybody, and what the pain point is that's being solved, then do they really have a business that's really that interesting?
yeah, that's true. But maybe it's just I am not knowledgeable enough to understand what the actual market is, because it's such a new technology. Or for example, blockchain, there could be so many uses, and many of those are not known today.
But you're
So
not going to, at least you shouldn't, like say, well, I'm going to invest in Bitcoin, right?
Right.
Which has like a ton of, or I'm gonna invest in Ether, or Ethereum, because it's got like so many use cases. But you might invest in a Web3 startup that uses that operates on the Ethereum blockchain. That's fine, but who is their customer, and what is the pain point that they're solving, and how do they solve that pain point? This is one of my biggest problems with a lot of crypto companies, is that it's like they're crypto for the sake of being crypto. They're blockchain for the sake of blockchain, but they don't actually solve a problem, and like solve any problems better than the status quo. Or if they do, it's only marginally better. And if you're only marginally better, it's really hard to get people to switch. Because it's like, well, it's what I'm using is already good enough. So like sometimes people will be like, hey, I've got Web3, and we're using the blockchain for Airbnb style, like short-term rentals like Airbnb. And it's going to be so great because we can use blockchain to verify credentials. We can use it for payment transfers. We can do all of these things. But then I'm like, hey, you know what's really hard? It's not like the pain point of Airbnb. It's not the payment transfers. That's not the hard part of Airbnb. The hard part is getting customers to come stay at my condo, right? And Airbnb solves that pain point pretty dang well. I'm not seeing how throwing like Airbnb on the blockchain is going to do a better job. Does that make sense?
Right. Yeah.
So spend some time and understand who the customer is and what their pain point actually is. And then that'll give you some good insight into whether or not this business is really interesting or not.
Okay.
I have a really quick question.
Yep.
Okay, just last one. So as far as the write-ups, I think these are, some really good questions. Just as far as, strategy and overlooking everything. As far as like evaluating and presenting the financials of the company, is there any specific things you want us to look for or get, like, a balance sheet, a statement of cash flow, or certain, metrics that would be really good for a presentation that we should try to check off?
Yeah, so we're going to cover financials next week.
Okay.
In general, the more around an income statement you can get, this does vary by business, but generally, like, income statement's going to be your most important, because companies are going to be valued off of revenue for the most part at this stage.
Okay, perfect. Thanks.
Yep. So we will give you more guidance on exactly what to show and how to show it next week when we cover financials. But in the meantime, yeah, try and get as much information around income statement as you possibly can. That's probably going to be the most helpful. Any other questions?
Nope.
All right. Well, let's wrap it up then. So just some dates. We're going to cover due diligence part 2, October 26th. And your 3 companies are due this weekend. Now, again, don't stress about this. Just pick 3 companies you're excited about. Write them down, write down the names, give us like 1-sentence description of what they do, and send it in. This is more, again, for your benefit than ours. We just want to keep you like on track, moving. We want you to have like some backups in case the one that you're most excited about ends up not being a good fit and you got to resort to another one. At least here we know that you'll have 2 more, but we do want everyone to submit 3 companies. And tell us which one you're most excited about, and we'll try and give you some feedback on it. Diligence reports are going to be due November 4th. So we'll cover financials and so forth on the 26th. And then you'll have basically a little over a week to get, like a week and a half to get your diligence report done. So start working. I would recommend starting working on your diligence report now. Yep. These are just the dates. These are on the websites, of course. And that's it for today.